For this video tutorial, I want to go over the IRS Form 1116 for the foreign tax credit. So the foreign tax credit form is filed when a taxpayer has foreign source income and foreign taxes that were paid on those earnings that they might want to claim a tax credit for on their individual or trust income tax return. So in our sample here, we've got John Q. taxpayer. He's filing a 1040. And it is part of a full tax return, so we'll go through the 1040 itself and then the 1116 as well. And in addition to this, I do have a simple Excel workbook here that summarizes some of the payment information. So in our example, our taxpayer received compensation while living abroad working for a Belize company. And so we've got the Belize dollar amounts, the amounts translated into US dollars, and we'll show how all this gets reflected on the 1116. And then lastly, I do have one slide here covering some background on the 1116 form and then the fact pattern that we're going to be working with. So at a high level, when we talk about the foreign tax credits, this 1116 is filed by U.S. taxpayers when they have foreign source income that was earned from either a foreign country or a non-U.S. a U.S. possession, and they paid foreign taxes on those earnings, right? And this is important because U.S. taxpayers, so U.S. citizens, are required to report their gross income from whatever source derives. So it doesn't matter if it's U.S. or foreign source. It doesn't matter where they're living. You have to report all of it, pay taxes on all of it. And so the foreign tax credit is designed to try to help eliminate or provide some relief on this double tax issue, right? So we can claim foreign tax credits to the extent that those foreign source earnings are subject to the same U.S. taxes. So the amount of the credit is going to be limited in some circumstances, right? So it really largely depends on the ratio of your foreign source income to your overall total taxable income, and then also depends on what the tax rates, right? What kind of effective tax rate do you have in the U.S. versus what was the effective rate paid on your foreign source earnings. And so we'll get into more of those details when we look at the 1116, and you'll see how all that kind of works together. So when we first start the 1116, we need to be mindful of the separate categories of income, which are frequently referred to as baskets, right? So we refer to baskets of income and the baskets of tax. So the separate categories that we see are general category income, passive, foreign branch. 951A is the GILTI income bucket that was added in 2017. We have 901J for income from sanctioned countries. If you live in a treaty country or a treaty might apply, we might have income that's resourced under a treaty. And then lump sum distributions applies to things like distributions from pension plans, retirement plans, that are from a foreign jurisdiction. Now, the most common categories that we see are certainly the general category income and passive. So general category income includes things like compensation, wages, salaries. And the passive category income is more portfolio type income. So dividends, interest, royalties, capital gains on the sale of stocks, bonds, other types of investments. Now, the reason why it's so important to be mindful of these categories is you have to separately track the taxes in each category. And you can't use taxes from one category in another basket. So in other words, if you have foreign taxes paid on compensation, which is part of the general category income, you can't use those taxes to offset tax liabilities in other buckets like for dividends or interest, okay? They've got to be separately tracked in each one. And if we have foreign tax credit carryovers, they carry over to the same basket, okay? Now, what about the translation? So foreign taxes paid, all of these dollar or numerical values have to be reported in U.S. dollars on the form. So when we look at the 1116, in most places, we're going to be reporting everything in U.S. dollars. So that means if you're obviously being paid and paying taxes in foreign currencies, you need to convert it to U.S. dollars. And so you're supposed to be using the exchange rate or that spot rate on the day that you receive the income, pay the taxes, right? That keeps the conversion as precise as possible. In some cases, you can use the yearly average rates, but what we'll see in our example is we use the spot rate on the dates that John was paid. Now, what about carryovers? If you're an individual taxpayer and you have taxes paid in the current year and you can't use all of them, right? So you've hit that foreign tax credit limit, so now you have a carryover. You can carry credits back a year and then forward 10 years. The one exception here is guilty income. So 951 Cap A, guilty income, there is no carry back, there is no carry over. So if you have taxes related to guilty income that you could not use in the current period, they're lost. All right, that's it. You don't get to carry them back or forward. All right. Now, let's have a look at the fact pattern itself. So John, taxpayer here, he's living in Florida, and he works as a business consultant. So he worked there for 5 months, and he was paid $55,000 in W-2 wages. So at the end of the year, he gets a W-2 for those amounts, right? Now, after he leaves this job, he takes a project overseas working for a Belize company, and it's a 3-month project, and he's going to be paid 20,000 Belize dollars per month. So a total is 60,000. Now, during the 3-month period, the 3 paychecks he got, the company withheld 8,250 Belize dollars in Belize income taxes, okay? Now, once John finishes the project, he flies back to Florida in November, and so now he's doing his tax return. He's trying to figure out, okay, well, what do I do here? Well, if we have a look at the return, the first things to highlight are page 1. So page 1, we can see here he's reported his wages from the Florida-based company. So there's the $55,000 from the W-2. That's fine. And then he has to also report, right, his other compensation from foreign sources. So the foreign earned compensation here is reported on line 1H, $30,132. So you remember he was paid $60,000 total in Belize dollars. So he's entered that detail there. And then this is the conversion, so the spot rate on each date. Now, you notice it's the same, and that's because Belize has their dollar pegged to the US dollar 2-to-1. Now, it's not exactly 0.5 because even though it might be pegged, it will fluctuate very slightly just depending on things like volume of currency moving. But he has looked up the spot rates on those states, and it was 0.5022. So he's used that to convert the compensation to the dollar, the US dollar value amount, and then he did the same with the taxes. So the amount of taxes withheld from each paycheck, he's listed them here, and then that's the conversion to US dollars. So on his Form 1040, page 1, he's reported that foreign earned compensation, so it's added to his total, right? It's included in his total income, and then after subtracting out his itemized deduction, or sorry, not his itemized deduction, he took the standard deduction. He's got his net taxable income from both U.S. and foreign sources of $72,000. Now, what does he do with the 1116? So this is where the foreign tax credit really comes into play and helps. If we look at page 2 of John's 1040, we can see the total tax is being calculated, $11,496. That's on all the earnings, right? So John is asking himself, well, wait a minute, I paid a lot of foreign taxes on those Belize earnings. What do I do with it? And that's where the 1116 comes into play. So first things to start with, we want to indicate what type of category of income this is. So he has checked appropriately here the general category of income. He is a resident of the U.S., and then the income that he's going to report here from foreign sources is Belize, right? So he's entered Belize up there, and then he's indicated the type of income that he's going to be reporting on this form. So the amount of income, or the type of income rather, was compensation, right? So it's wages, it's compensation, it's not portfolio income, right? So the $30,132, that's reported up there on line part 1, section I, 1A. And then in the deductions and losses section, now if you have any expenses that are directly related to this income, you can report them here. In this context, you don't often see that on the compensation or the wages. That would more likely happen if you were reporting foreign source business interest income. So if you had a business and you have flow through business income, the gross income would be reported up here, and then you would have expenses attributed to those earnings, right? So business related expenses. In this case, John doesn't have any of that, right? He just has gross income from his employer while he was over there. And so he is allocating a portion of that standard deduction to those foreign wages. So he's listed his standard deduction here. The total amount of foreign source income, gross foreign source income on line 3D is $30,132. Gross income from all sources, $85,132. You can find that on page 1, right? So total income from all sources, $85,132. That's on line 9 there, right? Okay, so we've got those two pieces there. And now it's asking us to divide the two to get a percentage, right? So we're trying to figure out how much of John's standard deduction should be allocated to that foreign gross income. So 30 divided by the 85 is 0.353. So take 0.353, multiply that, multiply line 3C by 3F. So we have 3C up here, 12,950. Times 3F, and we got 4,584. So John's foreign source gross income of 30 minus the 4,584 gives him a net foreign income of 25,548. So this is really important because when we get to page 2, this is going to be used to compute the foreign tax credit limitation. All right, so now what about part 2? So part 2 is where you report the actual foreign taxes paid or if they were accrued. So on line A here, because we're sticking with column A, right? We don't have any other foreign taxes or foreign income to report. So line A, the amount of taxes paid is reported in both the foreign currency and then the US dollar translated amount. So 8,250 Belize dollars, that was the foreign currency amount. And then that was the amount translated to US dollars, right? Remember using those spot rates on the date he was paid. And then for the date paid or accrued, because there are multiple line items here, you can put various. That's okay. All right, so now if we go on to part 3, figuring the credit. So this is the fun part. It's within this section that we not only account for carryovers, but we also try to calculate, okay, for the total amount of taxes that we paid, expressed in US dollars, 4,143, how much are we going to actually be able to claim as a credit, right? Because remember, there are limitations in play here that could limit the amount that we credit in the current period, and then it results in either a carryback or a carry forward. So starting with the top here, line 9, that's pulling from page 1, the $4,143. We don't have any amounts being carried over from a prior year, right? So the total amount of taxes that we're going to be working with here are going to be the $4,143 figure. Now lines 12 and 13, reduction in foreign taxes, you might have this apply if you claim the foreign earned income exclusion, because you would have to reduce the amount of creditable taxes by the amount that's being basically exempt. The high tax kick-out exception, if you have passive category income that is subject to a very high tax rate in the foreign country, you might be able to get that recategorized, and so that's what this line item is designed to do. These concepts are beyond the scope of this video, so that's why they're zeros. They don't apply to John for this year. So the total amount, again, he's working with here is $4,143. Now, the taxable income on line 15, right? It's asking us enter the amount from line 7, right? This is our taxable income from sources outside the U.S. before the adjustments, right? So that the 25,548, again, that's our gross foreign source income minus the allocation of the standard deduction, all right? Then on line 18, we report the taxable income from all sources, right? So the 72,182 is our taxable income here on line 15, $72,182. Now this is really important to highlight here, the caution. If you figured your tax using lower rates because you had qualified dividend income or long-term capital gain distributions, you don't just put the amount from line 15. All right. In our case, we don't have any qualified dividend income. We don't have any capital gains, no investment income at all. So we can just use that line 15 number. But if you have qualified dividend income or the long-term capital gains or those capital gain distributions, because they're subject to lower tax rates, you need to use the worksheet in the Form 1116 instructions to figure out what amount to put in here. All right. Because we don't have any of those items, we can simply use the amount from line 15. So now divide line 17, right, 25,548 by the total, and we get this percentage. So once we have this percentage, we then pull the amount of tax that's being calculated on our total taxable income. So that 11,496 figure, right, we can find that up on page 2. So the 11,496 figure, right, is the total amount of U.S. taxes being applied to all our taxable income. And once we have that, we multiply the ratio, so 0.3539 by the 11,496, and we get our maximum credit amount. So this is the limitation for the year. In other words, if we have foreign taxes that exceed this amount, those cannot be applied, right? They have to be carried back or carried forward. So if we go back up to line 14, right? The total amount of taxes we have available for credit, 4,143. Our limitation, the maximum amount of credit, is a lower amount, right? So we're only going to be able to claim $4,068 for this year. The difference can be carried back or carried forward. Okay, so the $4,068, this is what's being reported on page 2 of the 1040, right? So if we jump up here, firstly, it's being reported on Schedule 3, so we have the foreign tax credit amount, $4,068, and then it's flowing up to page 2 of the Form 1040, line 20. So we can see Schedule 3, line 8, amount from line 20, or being reported on line 20. There's our $4,068. So even though the taxes that we paid to the foreign country were, again, $4,100 and change, we're only being able to credit the $4,068. The rest of it has to be carried forward. And so that those carrybacks are also reported on the 1116. So Schedule B is where we report the carryback amounts. So we look at Schedule B here, Foreign Tax Carryover Reconciliation Schedule. The amount of the carryover generated in the current year reported here on line 6. In the current tax year column, $75. Right? So the $75 again is quite simply the 4,143 minus the amount of credit used, $4,068. And so that gives us a carryover for the current year of $75. So if John is able to carry this back, he can carry it back and use it. If not, then it's just carried forward 10 years. So when John does his 1116 for next year, he's got to make sure to capture this $75 carryover. And then if he has any excess limitation for next year, he might be able to use this. All right, so that covers it for this video. I hope that was helpful. I hope I went through each element in enough detail so you followed it easily. If you have any questions, please feel free to leave a comment below. And as always, I look forward to seeing you again on the next video. Thank you.